62 trading days. That is the number I want you to hold in your head for the next 20 minutes, because by the time this video is over, you are going to understand exactly why that number matters, and why almost nobody in mainstream financial media is talking about it. Here is what is happening right now. The registered silver inventory on COMEX, the pool of metal that is actually available for physical delivery against futures contracts, has been draining at approximately 24 million ounces over the past 30 days. At that pace, the Gold-Silver AI Stress Index estimates the deliverable registered pool could be depleted within approximately 62 trading days. At the same time, on the other side of the world, the Shanghai Gold Exchange is pricing physical silver at a persistent premium of $3 to $5 per ounce above the COMEX benchmark. Silver is sitting around $86 in New York right now. Shanghai is paying more than that, significantly more. And it has been doing that across multiple trading sessions. Two things happening simultaneously: Western vaults draining, Asian buyers paying above paper price. And the question this video answers is what that combination actually means for someone sitting at home right now holding physical silver or mining stocks. Stay with me because the answer is more nuanced than most channels will tell you. If this kind of calm, data-first breakdown is what you have been looking for, hit the like button right now. It tells me to keep making these. And if you are not subscribed yet, now is the time, because what we are covering today is part of a bigger picture we are building week by week. My name is John. I spent 15 years working inside currency and commodity markets before I started making these videos. I have sat in rooms where supply and delivery mechanics get discussed at an institutional level. I have watched what happens when retail investors get the wrong information at the wrong time about physical markets. That is why I am here, and that is why Currency Insider exists. To give you the same analytical framework the institutions are working with, sourced from publicly available data. Everything I show you today comes from public sources. I will name everyone as we go, so you know exactly where it is coming from. Today we are covering three things specifically. First, what the COMEX registered inventory drain actually means mechanically, and why the 62-day figure matters without being misread as a doomsday clock. Second, why Shanghai paying above COMEX is a structural signal and not a local market quirk. Third, how the macro picture, dollar rates the Iran situation, interacts with all of this and what the realistic bull and bear cases look like right now. Let us get into it. Silver right now is sitting at approximately $86 per ounce on COMEX. 3 weeks ago it was closer to the low 80s. If you are holding physical silver, you felt every dollar of that move. Gold is sitting at approximately $5,182 per ounce, just below its January record. The gold to silver ratio, the number that tells you how many ounces of silver it takes to buy 1 ounce of gold, is currently around 60.3. I want you to remember that number because we are coming back to it. The catalyst for this video is a specific combination of signals that showed up together this week: the persistent Shanghai premium, the COMEX withdrawal pace, and a macro environment that is creating genuine uncertainty about where paper prices go from here. The central question I am answering today is this: is the physical silver market actually tighter than the paper price is telling you? And if it is, what does that mean practically? Here is what most people are saying about the COMEX registered inventory number. They are saying it means silver is about to run out and the price is going to explode. That narrative is everywhere right now, and here is where it gets complicated, because the reality is more precise than that, and precision is what actually helps you. Let me explain how COMEX inventory actually works, because this part matters. COMEX silver inventory has two categories. Registered inventory is metal that has been certified, warranted, and is available for delivery against a futures contract right now. Eligible inventory is metal sitting in COMEX-approved vaults that has not been formally committed for delivery. It is owned by someone sitting there, but not yet in the delivery queue. When people talk about the 62-day depletion clock, they are talking specifically about the registered pool. When I pulled up the most recent CME warehouse report, here is what the data showed. Registered silver has dropped by approximately 24 million ounces over the past 30 days. Now here is the analogy that makes this click. Imagine a hotel. Registered inventory is the rooms that are cleaned, made up, and bookable tonight. Eligible inventory is the rooms that exist in the building but are under renovation, or being held by long-term guests who are not checking out yet. If the bookable rooms drain to nearly zero, the hotel does not close, but it does have a problem on check-in night. That is the mechanical situation COMEX is navigating right now. The 62-day figure is not a countdown to default. The CME has mechanisms, eligible to registered conversions, emergency vault arrangements, that prevent a hard default. What the 62-day clock actually tells you is something more subtle and more actionable. It tells you when delivery pressure becomes a genuine price factor. The May and July contract expiry cycles fall inside that window. And when physical delivery demand meets a tight registered pool, the paper market cannot simply ignore it. The next thing I want to look at is the Shanghai signal, because this is the one that actually stopped me when I put these two data points together. The Shanghai Gold Exchange, the SGE, is a physical delivery market. When you buy silver on the SGE, you are buying real metal that changes hands. Compare that to COMEX, where historically fewer than 1% of contracts result in actual physical delivery. Most COMEX trading is paper, positions that get rolled, closed, or cash settled. So when the SGE is persistently pricing silver $3 to $5 above COMEX, roughly a 3.5 to 6% premium, that is not a technical anomaly. It is the physical market telling you something the paper market has not priced yet. What it is saying specifically is that Chinese buyers, and China is the world's largest silver consumer, are willing to pay above the global benchmark to get hold of real metal. Now, before you run too far with that, there is something important I need to be honest about. SGE premiums can reflect local factors, import taxes, financing costs, local market structure, that are not purely about physical scarcity. The premium we saw in December 2025 widened to between $8 and $12 per ounce. We are not there yet. What we currently have is a persistent baseline premium that is held across multiple sessions. That persistence is what makes it a structural signal rather than a one-day noise event. Think of it like a thermometer. One high reading might be a spike. A week of consistently elevated readings tells you the patient has a fever. If you know someone who has been watching silver this week and trying to make sense of these moves, share this video with them right now. This breakdown took real time to put together, and the people who need it most are probably not searching for it. Now let us layer in the macro picture, because this is where the story gets genuinely complicated, and I want to give you both sides honestly. The DXY dollar index is currently sitting around 99.1 to 99.4. A stronger dollar is traditionally a headwind for dollar-denominated metals. When the dollar is bid, non-yielding assets like silver face short-term selling pressure. The 10-year Treasury yield is at approximately 4.15 to 4.17%. Elevated yields are another traditional headwind. They raise the opportunity cost of holding metal that pays no interest. So in a pure textbook framework, right now you have two macro headwinds for silver. Here is where the Iran situation adds a layer that the textbook does not cover cleanly. February CPI came in at 2.4% year over year, in line with expectations, according to the Bureau of Labor Statistics. But that number does not yet fully capture the energy price impact of the conflict. The Federal Reserve is expected to hold rates steady at the March 18th meeting. War risk is keeping the dollar bid, which is a headwind for metals, but war risk is simultaneously keeping safe haven precious metals demand structurally elevated. These two forces are pulling in opposite directions at the same time. This is not a clean story. Anyone telling you it is a clean story is simplifying it past the point of usefulness. Here is the macro line I want you to take from this section. The direction of travel on fiscal pressure, the Congressional Budget Office deficit projections, the trajectory of Treasury issuance. That math is getting harder to ignore, regardless of short-term rate moves. I'm not saying the dollar collapses. I am saying the structural tailwinds for gold and silver as reserve assets are not going away because of one CPI print. The Bank of England reserve data and the LBMA vault activity in London are showing a similar directional picture on gold. And for UK viewers holding gold in a SIPP, that institutional context is worth tracking because it reflects where the professional allocation conversation is heading on this side of the Atlantic too. De-dollarization is a decade-long structural process. It is not a Tuesday event, but the direction of travel is visible and documented. Now, industrial demand. This part of the silver story gets underreported because it is less dramatic than the vault drama, but it is arguably more durable as a fundamental driver. Silver is not like oil where you can watch it burning. It is hidden inside electronics, solar panels, medical devices, EV connectors. It is everywhere, and it is rarely recycled perfectly because it is dispersed in tiny amounts across massive industries. The Silver Institute, which tracks industrial silver consumption, has documented the continued growth in solar panel manufacturing as a primary demand driver. Each solar panel contains a meaningful amount of silver in its photovoltaic cells. Scale that across the global energy transition. including the UK's North Sea offshore wind build-out and onshore solar rollout. And you are talking about industrial demand that does not soften just because a futures trader in Chicago changes their position. Now here is the honest caveat I need to give you, because you deserve precision, not hype. There is a phenomenon called thrifting, manufacturers' engineering processes that use less silver per unit to manage costs. The Silver Institute data acknowledges this. I am not going to give you a precise ounce per megawatt figure because that would be false precision. What the data shows is the direction of demand, and that direction has not reversed. All right, let me show you how I am actually thinking about this week using the 3 lanes framework. This is how I separate what is noise from what actually matters. Lane 1, the paper market. The CFTC Commitment of Traders report is the lens here. Managed money positioning, the hedge funds and professional traders, has been at relatively subdued levels recently. When hedge fund net longs are low, it means 2 things simultaneously. There is less speculative pressure holding the price up, but there is also a significant potential fuel tank of new long positions that has not been deployed yet. A compressed positioning baseline historically precedes sharper moves when a catalyst arrives, in either direction. Lane 2, the physical market. COMEX registered inventory draining at 24 million ounces in 30 days. Shanghai premium persisting at $3 to $5. Royal Mint silver coin sales in the UK have remained elevated compared to the prior year period. Physical retail demand has not softened despite the price move. These are not paper signals. These are people and institutions taking delivery of real metal. Lane 3, macro. Dollar at 99.1 to 99.4 on the DXY. 10-year yield at 4.15%. Gold at 5,182s with the gold-silver ratio at 60.3. That ratio is the one to watch. Historically, when physical silver tightens ahead of gold's physical market, the ratio compresses, and silver's catch-up move can be rapid. In 15 years watching currency and commodity markets, the times I have seen all 3 lanes send signals in the same direction, even briefly, have historically been some of the most significant moments in these markets. I am not saying all 3 are perfectly aligned today. The paper lane has macro headwinds, but the physical lane and the structural macro lane are pointing the same direction. That gap between paper signal and physical signal is exactly where the interesting dynamic lives right now. When the paper lane is showing headwinds while the physical lane is draining and pricing above benchmark, the historical pattern has been eventual convergence. Whether that convergence comes through physical prices pulling the paper market up or paper market softness pulling physical premiums down is the live question. That is a framework, not a forecast. You decide what to do with it. Here is the one thing I am personally watching this week. One thing, the COMEX eligible to registered conversion rate. Here is why that specific metric matters more than spot price right now. When the registered pool drains, the pressure valve is how quickly eligible metal gets converted into the registered pool. If conversion accelerates, the 62-day clock resets. If conversion slows or stalls, if eligible holders are not willing to commit their metal to the delivery queue, the pressure on May and July expiry dates becomes acute. The CME publishes warehouse data daily. I am watching specifically whether we see a meaningful conversion event before the end of this week. If we do not, if registered continues to drain without eligible conversion stepping in, that tells me the eligible holders are not motivated sellers at current prices. And that changes the delivery pressure calculation materially heading into the May contract cycle. This is my one call for the week. John, FX Insider. On record. I will be back next video to tell you exactly what happened. No edits, no excuses. That is the only way this works. Now here's where I want to be completely straight with you, because this is where most channels pick a side and run with it. I am not doing that today. Here's what needs to happen for the optimistic picture to develop. The Shanghai premium widens toward that $8 to $12 range we saw in December 2025, eligible to registered conversion stalls, putting genuine pressure on May contract delivery. The gold-silver ratio begins compressing from 60.3 as silver's physical tightness gets priced in. The Fed holds rates and the dollar softens modestly, removing the macro headwinds. In that scenario, silver's move from current levels can be meaningful and relatively fast. Here's what needs to happen for the cautious picture instead. Iran conflict moves toward ceasefire or de-escalation. Oil dumps. The dollar weakens in ways that lift gold strongly, but silver underperforms because recession fear clouds the industrial demand outlook. Chinese factory activity softens, SGE premium collapses, and the eligible inventory holders step in to convert metal into registered, resetting the depletion clock. In that scenario, the paper price could give back a significant portion of recent gains, and the physical premium story becomes a non-event for months. Both are genuinely possible right now. Your job is not to pick one and emotionally commit to it. Your job is to watch which conditions are actually developing in real time. The market will tell you. You just have to be watching the right things when it does. Before we close, the disclaimer you need to hear, and I mean it. Everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here should be construed as a recommendation to buy, sell, or hold any asset. Past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions. Before the two questions, if you got value from this today, the like button takes 1 second and it genuinely helps this channel reach people who are trying to navigate these markets without all the noise. Hit it now. I want to ask you two things, and I genuinely want your answers, not just a thumbs up. First, are you currently seeing elevated premiums at your local dealer or bullion platform this week, or has retail pricing normalized relative to spot? Second, given everything we covered today about the gap between COMEX paper positioning and physical delivery signals, do you think the paper market catches up to physical, or does physical come down to paper? Drop both answers below. The comment section here becomes a real-time sentiment tracker, and I read every single one. Subscribe, because next week we are going into the gold-silver ratio in detail, specifically how to read it as a timing signal rather than just a snapshot number, and that is a skill worth having. And if someone in your life is watching their stack right now and feeling confused about what is happening, share this with them. That is the whole point of this channel. This is Currency Insider. Know the market, protect your currency.